Twitter. Boy. um, yeah, I mean, Twitter's a disappointing start for me. It really is, but yeah, you will see why. Um, Twitter, microblogging social media platform. Margins. I mean, that just speaks for itself, doesn't it? That really does just speak for itself. Um, Twitter's margins have been in decline, and you know, earlier on, in the previous analysis, I think with Alphabet and Baidu, I said that declining anyway, but I said declining money is not another problem as long as they can be justified. You know, as long as they can be justified, but they shouldn't be like a massive deterioration like we have here, where you go from 14% positive margin to a negative 1% margin. This is just horrifying. This is really, really, really horrifying. I mean, this is a clown circus of horrifying. It's laughable, because you know Twitter has just been shooting itself in the foot and hitting itself, with a pie in the face every hour and every second. But anyway, this is just horrifying. This really is horrifying. Now, what's the reason for this? There's a lot. Let's start with the obvious one. The obvious one is Twitter, unlike Facebook and Alphabet, has kind of refused to diversify. You know, Meta, I said Facebook again, so wow, the mispronunciation jar is really filling up. So Meta has diversified. Yes, a lot of its revenue still comes from ad-based services. However, it is using its platform as a springboard to diversify into a myriad of other industry, other revenue sources. Same thing with Alphabet. However, Twitter has just refused to do this. And we will get into that more with a very um, heartbreaking example of Twitter. So to refuse to diversify, on top of refusing to diversify, it's very small compared to the billions of users. I think it's 2.6 billion or so users use Facebook on a monthly basis. And Twitter's daily active users are still in the high hundreds of millions. I think they call it monetizable daily active users. So monetizable daily users, call it that. Um, that is in the high hundreds of millions of something. It's under 200 million. It's actually between 100 and 200 million. And yeah, compared to the billion user juggernaut that is Meta, the company formerly known as Facebook, that's pretty small. So Twitter has kind of failed to reinvent and diversify its platform. And that has resulted in some of the big boys eating into its profit and market share. Furthermore, going back to our analysis, been growing at costs have been growing at a pretty upward trend. Um, Cost of revenue has been increasing at an upward trend. Growth in R&D has been increasing at an upward trend. This is despicable. How do you spend 2%? How do you only grow R&D by 2%? Especially in 2018. That is just a no. And that kind of also gives an indication of how far Twitter has lagged behind some of the bigger boys. That it really should have not spent. They should have spent a bit more on R&D. And you can see, over the coming years, it has been basically playing catch up. R&D as a percentage of revenue, playing catch up. Sales and marketing, but on a high end, increasing at an upward trend. The average for the industry, for this industry, is about 25%, and Twitter is spending exactly 25%. So spending on the high within the industry average, but it's on the high end. And the question is it justified? I mean, you're spending 25% of your revenue on average on sales and marketing, but your revenue have been declining at a rapidly disappointing trend. They've been declining rapidly. So your cost of revenue, so your sales and marketing cost is on the high end, but revenue has been declining. So spending way too much on sales and marketing, which are not justifying your revenue growth. Your revenue actually decreasing. Spending a lot on R&D, spending a lot on cost of revenue, and that is not filtering down to your top as well as bottom line, so revenue and net income. Margins are still declining, so your costs are not justified. You're spending a lot, but we don't see it. We don't see the fruit. We don't see the realization of that spend in the revenue, the net income, and the margin. So a bit of inefficient spend here by Twitter. I mean, it's still a $3.7 billion company, but one cannot help but wonder if it could not be more, and it could be more. Now, interest expense that has eaten also a bit into margins. I mean, the interest expense has been a decrease in 2019, but upward tick in 2020. So it's been quite high. The growth in it has been quite high, 14% on average. For a company like Twitter with the significant cash resources it has, does it we need to borrow? Okay, maybe it does. Considering it's a bit behind the big boys. Okay, but it's borrowing a lot. But I don't see it in the margins or the growth in the net income or the revenue. I don't see it. Now, yes, understand that when you do borrow, it might take time to realize the fruits of this increased expenditure that you've added to the financial performance of the company, that you've added to the company in the form of increased expense. I mean, because the margins are declining, you're eating a bit into your margins, and your net income is declining. Oh boy, look at that, 113. So you're eating a bit into your net margins. You're eating a bit, and it's not justified. And it doesn't look like it's justified because all this expenditure that Twitter has been engaging on, it looks like it's just to plug holes rather than to actually use this cash, these resources, to actually make a solid push to take on some of the big boys. Twitter does not really make any significant, I would call it like a YouTube or like an Instagram kind of elephant purchase, like what YouTube was for Alphabet, a company formerly known as Google, and Instagram was for Meta, a company formerly known as Facebook. So you're growing, your interest expense, and we can see that you are growing your borrowing base, but all this is just to plug holes. Not really to expand the platform, and not really to expand the company itself. So a bit worrying, increase in risk, not really justified because revenues are declining, net income is declining, margins are just pathetic, they're awful. Increasing costs are unjustified because, well, top and bottom line of the margins are on a downward trend. They're depreciating rapidly. Return on equity. Poor, very, very, very poor. Um, only outperformed the S&P one of the 3 years. Only outperformed the S&P in 2018. The rest of the years, it's underperformed the S&P. The S&P 500 over the same 3-year period provided returns of 13%. Twitter only provided 3%. Not efficient use of shareholder capital. So yeah, the return on equity is very, very laughable, but that is expected considering the pressure that the margins are under and the revenues are under and the net income under. So yeah, mediocre financial performance tends to be followed by mediocre return. Current ratio, looking at my financial position. Twitter, operating in that industry, low asset, high cash. So do I expect? Yes. So do I expect a good balance sheet? I do expect a good balance sheet, and there is a good balance sheet, and you can see, slight decrease, but I mean, well, massive decrease, but 4.4. So current liquid assets exceed current liquid liabilities by a factor of 4. So very, very good. Shows me that balance sheet is very, very liquid. Okay, the debt to equity, as you can see, it's deteriorated. The increase represented deterioration. 68%, it means that debt is 68% of your net worth. I mean, it's still very good considering, it's below the 100%, a 1-to-1 factor. It's at the ratio of basically for $1 of net worth. Twitter has it only holds 68%, 8 cents in debt. Still very good. However, the deterioration worries me a bit. Because if I look at the relationship between risk and return, I'm increasing my financial and credit risk, but my returns on my top and bottom line of Twitter aren't that good. Not that good. It's pretty mediocre. So the increase in debt is not really justified. I mean, what are you doing with all this cash, Twitter? You're not being very effective with it. Cash from operations. So the net cash flow from operating activities margin has been declining. Yeah, yeah. The silence is deafening, isn't it? How is Twitter still losing money? Is astounding, considering it's one of the matured, it's one of the big boys, but it's behaving like an IPO or a startup, that's still finding its feet. You know, but anyway, let's continue with the analysis. It's on a decline, trend. It's depreciated significantly, and that too is very, very well. I mean, yes, Twitter is still able to generate cash flow from its margin, from its operations. For each dollar of revenue Twitter makes, it turns it into 27 cents of cash, 27% of cash. So it's still making cash from its operations, but at 27%, and considering it's declining, it's very, very low. And how do we know it's low? Just look at that. The sufficiency of cash flow tells us Twitter does not have sufficient cash flow available to fund investing activities to grow the platform, its platform and its operations, to pay lenders as well as to reward shareholders. It does not have enough cash to fund its operations, which is a bad thing. Very, very bad thing. And what happens, it needs to borrow more to plug all the holes. And that adds more pressure on my margins and my net income. So very, 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 very bad. Now, this to me was a bit irresponsible in 2019. You paid 72% of your net cash from operating activities to shareholders. Good thing, don't get me wrong, it's a good thing. You want to pay your shareholders, but the question is, your margins were already declining, your net income was in decline, your revenue was in decline, your ROE was in decline. Did you really need to pay such a significant part of your net cash to shareholders when you could have rather kept hold of that money, not borrowed as much as you would have, reduced your credit risk and your financial risk, and probably improve your cash margins as well as the sufficiency of cash flow, and use your that cash to basically expand and improve your platform. So this to me is a bit irresponsible. It was just basically get a reaction of the stock price, but this should happen. Now at the PE ratio. PE ratio, now it's not necessarily a PE ratio because in 2020 Twitter made no money, made a loss, so it's trading at a price to sales. Bearing in mind Twitter is bloody too matured to be trading at a price to sales, but it is. We find ourselves having to look at Twitter as if it's a startup. Like, Thanos in heaven, Twitter. Now it's trading at a 11 multiple. So for each dollar of sales Twitter makes, you're paying 11 times above that to own the stock. Now, is that good? No, it isn't. Twitter should not be trading at a price to sales. It just shouldn't. Twitter should not be exposing us to these horrifying numbers. It just shouldn't. All right. Now, Twitter has been unproductive. It's been unproductive by using its operations to generate returns for shareholders. It really has been significantly unproductive, and we can see that with the declining margins and the price to sales ratio. Now, however, Twitter looks like it's turning around its operations. It has gotten a new CEO, and they're basically taking the CEO approach that Alphabet and Microsoft took, which is basically getting an outside insider. So somebody who's been with the company, who's worked his way up the ranks, but is outside of that founders group. So he's gonna come in, and knows the company because he's come through the ranks, knows the company inside and out, but he's gonna come with some fresh ideas outside that founders group. So he's gonna come with some fresh ideas, and you can see what that approach did for Microsoft by hiring Satya Nadella, as well as Alphabet with the Sundar Pichai hire. I really overpronounce those names. You can see what those appointments did to those companies. They turned them into pretty average flat companies into trillion-dollar behemoths. Now, do I think Twitter can become a trillion-dollar behemoth? Yes, I do believe it. However, that is going to be on how the CEO communicates his vision, executes his vision, and is allowed to turn around Twitter into basically his image, like Sundar did with Alphabet and Satya did with Microsoft. So this does give me a lot of cause for optimism with Twitter. It's been a pretty flat, capital destroying stock, but this appointment of a new CEO, because it's worked twice in the past. It's worked with Microsoft, it's worked with Alphabet. There is a pattern that it does work, and if applied correctly, it could work with Twitter. So I'm not a fan of Twitter at the current moment, but this CEO appointment has made me a bit optimistic and a bit bullish about Twitter. Not to put my money in it, but to keep an eye on. Good.